Let's continue that conversation. Bring in Citi U.S. equity strategist Scott Chronert and Wells Fargo Investment Institute's Tracy McMillan. Guys, great to have you. Scott, I'd love to just get you to bounce off of Griffin's thoughts and talk about, if not bonds, at least how equities tend to behave in a year following inflation peaking.
Well, yeah, I think that's a really good question. So typically inflation peaking comes with it the other side of economic traction, if you will. And so typically it's the Fed response to peaking inflation that leads to a more onerous economic outcome, which is why we're talking about recession risk for much of the 23 or first half of 23 timeframe. Bottom line is, how do you position against that? There's a school of thought from a cross-asset perspective that in that scenario, you're going to favor the fixed income side of the equation. And per that previous commentary, the rate backup is giving you a different way of thinking about the 60-40 equation versus the highly correlated construct we've had between equities and fixed income over the past couple of years.
Right. You had a note the other day where you talked about the Fed increasingly using its voice as a policy tool, and that may have an impact on behavior that might force you to rethink your view of a severe recession, which you had pretty low odds on.
Right. Yeah. So, essentially the Fed it was very clear at Jackson Hole that setting inflation expectations is part of the fight against inflation. And we're just making the point that we think they're using their voice as part of that. And so the determination around using the Fed funds policy rate tool to affect inflation is certainly part of the discussion that ultimately affects behavior. The bottom line here is that there's no view, there's no, I think, surprise here that as you continue to work that policy towards higher Fed funds rates, you do begin to bear the risk of a more dire economic consequence on the other side. And we had given severe recession sort of a 5% probability. I think what we're suggesting is that I think that probably has to get tweaked up as we move forward.
Okay. Tracy, I want to get your thoughts on this, too, on this idea of the 60-40 portfolio looking much better today. Do you agree? And how are you counseling investors to put their money to work right now?
We do agree. What we're seeing here is those higher bond yields, and those higher bond yields do make bonds more attractive than we've seen in years, really over the past decade. But we want to counterbalance that with the growth prospects of equities. We do still have an earnings correction ahead of us, and we also have what we believe is going to be a global recession ahead of us. So if investors are waiting until we get through those, then it's probably too late. If they jump in ahead of those events, it's probably too early. So what we're counseling our investor to do is to stay patient here, to play defense, to have that diversification of a more balanced portfolio with both bonds and equities allocations in them, and diversify further into things like commodities and alternatives.